I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get straight to the burning issues in private markets. The massive shift toward private capital may just be beginning. That's according to BlackRock, even as some start pulling back. Plus, cold, hard cash private equity firms keep raising more dollars for tech startups despite some recent high-profile stumbles. And we head to the auction house for, get this, the most expensive sweater of all time, the vintage green cardigan of the late musician Kurt Cobain. Let's get into some of these burning issues. With me, Bloomberg's Annie Massa, Jason Kelly, and Davide Scigliuzzo. Let's start with you, Annie. BlackRock, other asset managers increasingly catering to this shift toward private markets. How is BlackRock trying to position itself?
That's right. Even though BlackRock is an indexing giant, they've moved increasingly towards alternative investment in the past couple of years. One cornerstone of that has been their attempt to raise this long-term private capital fund, which they're targeting $12 billion in fundraising for.
How successful have they been?
So far, as of April, they've only got $2.75 billion committed, so they've still got a long way to go before they reach that goal, but they announced their first kind of investing effort over the summer.
All right, so Bloomberg's Eric Shasker recently sat down with Mark Wiseman, BlackRock's global head of equities, on the shift. Take a listen.
Well, I think we may see companies stay private for longer as a result of the availability of that capital, as a result of the cost of being a public issuer, as a result of the some of the transparency.
That was Eric Shasker and talking about just this shift toward private, which brings me to KKR. The firm has raised more than $2 billion to invest in fast-growing tech companies as they expand beyond the mega deals for their for returns. I'm just wondering, Jason, more money for tech startups. Why?
Right. Well, as Mark Wiseman said, these people need money. KKR, among those stepping forward, say, hey, we got money. Yep. We got money. You need some money? But yeah, it's coming in at a time where WeWork is not that far in the past. It just happened in the last couple of weeks. These high-flying tech startups may or may not be a really good deal, but what we know is the investor appetite is huge. This is triple what KKR raised the last time they went out.
But why? Why aren't people concerned about what they've seen in terms of some of the recent blow-ups with WeWork? Evidently the latest, by the way, since we can't go a show without talking about WeWork.
Of course.
They're working on gaming,
right?
Online gaming now.
Well, now keep in mind the private markets, WeWork may be an outlier to some extent. That was a valuation that, as you well know, was really distorted by one single investor, SoftBank's Vision Fund. But you look at even something like Peloton, which, while it hasn't been a darling in the public markets, it's still trading well above its last private round. It had to raise billions and billions to get there. And so these private equity or growth equity type funds are more than willing to do that. You think about a General Atlantic, you think about KKR coming in, there's a lot of enthusiasm here, TPG being another example.
Yeah, and so there's really a question here of fundamentally how things are doing, which leads me to some of the risks that have been highlighted in the leveraged loan market. Barclays Chief Executive Officer Jess Daly recently commented on some troubled deals. Take a listen.
If you have a deal that's not structured properly, that has some idiosyncratic weaknesses to it, the market can be pretty punishing at the bottom end. But a couple of idiosyncratic deals, I think, have opened people's eyes that it's not a free ride right now.
Davide, how much of a concern for big banks have some of these more difficult loans been?
We've certainly seen some loans struggle to get done in the market, and these are loans used by private equity firms, usually to find buyouts. The tally stood at around $2 billion, little over $2 billion as of mid last week. Then one deal got sold just on Friday, so we're probably closer to $1.5 billion now. This compares to a market that is $1.2 trillion in size and around $170 billion of loans that have been sold for private equity buyouts in Europe and the US this year. So it's not a huge issue, but it's worth paying attention to because in prior episodes, loans like these got hung when there was a bout of volatility. among risk across risk assets. We haven't seen that now. If you look at equities, if you look even at junk bonds, they're all doing pretty well. Returns are good for the year. So it just speaks to how some investors, particularly in the loan market, where you have managers facing outflows from mutual funds and CLOs with limited appetite for risky deals, are unwilling at this time to finance some of the riskier transactions.
Davide, thank you so much, and to all of our reporters, thank you so much. That perfectly brings us to my next guest, Michael Herzig, THL Credit Head of Business Development. Michael, you focus, and you have for more than a decade, on the collateralized loan obligation market. People have raised concerns about it recently, and I'm wondering, do you think that there is legitimate trouble brewing in this market?
This is a market, as you say, that has been around for 25 years. And so I think what we're seeing today is the normal push and pull of supply and demand going after one another. We are indeed getting into a point where we have some economic weakness. We're not anywhere near a recession in our minds.
Wait, hold on a second. Economic weakness. What are you pointing to in particular?
We're seeing some companies that are not performing as well as they had been a year ago.
But is that economic, or is that related to specific companies that might have gotten financed just fine a little while ago?
I would say it's a little bit of both. It's industry by industry. Certain industries don't lend themselves well to operating in a highly leveraged environment. People with volatile commodity inputs or a lot of labor exposure or exposure to tariffs. And with leverage, it's more difficult. But the CLO market has been through crises in 1998, 2001, 2, and of course 2008, and has come through with really good performance for all investors involved.
One concern that people have is that there are constraints for how much of the lowest rated debt CLOs can buy. And there's concern that if there are downgrades, there could be forced selling. Do you see that as a possibility?
No, that's not exactly right. It's not a forced selling scenario. What there is there's a finite amount of shelf space for any CCC rated companies. And of course, that moves up to the B3 rated companies that might be the next CCCs. So what you see is an increase in the ante to get into a portfolio as a B3 company, so that new issues that might be coming that are rated B3, now they have to pay a much higher rate in order to qualify for that limited space in CLO portfolios.
So you don't see that as sort of a looming pressure?
It's a constraint, and that's a constraint that can break one of a few ways. Either B3s will get cheaper so that it's worth owning more of them, or we'll see more new issuance come at a B1 or B2 rating to alleviate some of that pressure that the CLOs have.
We've seen a number of loans decline in price quite significantly, and this has come in tandem with ongoing outflows from retail funds. And I'm just wondering how you interpret that.
So the whole appeal of the CLO market is that it's not the retail funds. These are institutional vehicles that are not redemptive. They are never forced sellers. That is why they have succeeded in periods of volatility. In fact, a lot of times CLOs are the beneficiary of price volatility in the market, as they can be a non-mark-to-market buyer of any loan that they deem creditworthy.
So have you seen institutions continue to invest heavily in CLOs?
Absolutely. CLO issuance has been very, very strong this year, well over $100 billion for this year as well as last year. And while I think in 2020 we're expecting a little bit of a reduction, it's still probably going to be a $100 billion year.
And we have seen the Bank of Japan recently issue some guidance, a warning to Japanese investors about the potential for price drops. Does that affect anything?
That's right. I know that there's a focus on, hey, what about the price drops? But if you read the report, as many of us have, they reiterate that these AAA notes that most of these Japanese banks own have very, very little credit risk and have never experienced any losses.
And they haven't pulled back?
They have not pulled back, though they were very heavy buyers, some of them, in the beginning of this year. And I think they filled a lot of their quota when spreads were wider. And I think if spreads widened in the fourth quarter, we could easily see them come back in.
Michael Herzig, thank you so much for being with us.
Thanks, Lisa.
Michael Herzig, THL Credit Head of Business Development. America's middle class is getting hooked on debt with 100% rates. We're talking about installment loans here, which have gone from a relatively niche offering to a red-hot industry. Subprime borrowers now collectively owe about $50 billion on installment products, this according to recent TransUnion data. On one hand, this gives people access to credit. On the other, the debt often comes with triple-digit interest rates. Coming up, Jonathan Grable, Chief Investment Officer for the Los Angeles County Employees Retirement Association. He discusses the increasing investments made by pensions into private assets and how they are allocating their money. This is Bloomberg Money Undercover. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for our power player, or look at some of the most notable names in private markets. Pensions have increasingly invested in private equity, private debt, and real estate over the years as they seek to boost returns. But the question is that trend losing steam? We're lucky to get the perspective from John Grable, Chief Investment Officer for the Los Angeles County Employees Retirement Association. He comes to us amid lots of traffic and other things in Los Angeles. Thank you so much for taking the time to be with us. I wanted to start first with, you recently changed some of your allocations, the way you allocate money, that actually included lumping private equity with public equities. Can you explain a little bit about why you did that?
Sure. It's good to be with you, Lisa. The reason that we do it really starts with our mission and why we invest. And we invest on behalf of our 170,000 members to pay benefits today and into the future. And accordingly, we have some assets that are safe, provide downside protection, such as investment-grade fixed income. And then we have others that help grow the fund to pay benefits into the future. And that predominantly includes investments writ large. And across the equity spectrum, we have some investments or one way to say it is, all other things being equal, we would like to invest in the lowest cost, most liquid form of an exposure to gain access to that factor. And in some cases, we do that through public equities. In other cases, we do it through private equity. But fundamentally, equities as a whole give us exposure to long-term growth.
So, John, recently you've been reducing your allocation to equities broadly, but in particular, public equities. Have you also continued to reduce private equity investment?
Well, still, public equity is our largest single investment strategy. We have not reduced our exposure to private equity. That's still about a 10% allocation. Both, as you mentioned, public and private equity both reside in our growth portfolio. But we've allocated our asset categories more broadly, somewhat more defensively, but to allow the fund to perform in multiple investment environments, not just the one we've had over the last decade that's really been dominated by growth and low inflation.
So given the low interest rate environment, have you reduced your annualized returns expectations going forward?
It's interesting that you ask, because right now our board is in the middle of what's called an experience study, where we look at many of the actuarial assumptions used by the fund, one of which, or a principal one, is the investment return assumption. So it's something that the board is in the middle of a very deliberate process to evaluate. So we haven't reduced it, but it's something that the board is looking at. But part of this exercise, because we believe that we are in a more muted or lower expected return environment that's somewhat anchored by a 10-year at, you know better than I, at 1.85 or so today, that really forces us to really look to optimize all aspects of our model. In addition to our return assumptions, we want the sharpest implementation possible. We want the best of breed implementation, and we really look to eliminate all the low-hanging fruit and to really prevent the portfolio from working at cross purposes. For example, if we have one manager that's long Apple, another that's short Apple, we need to understand that total exposure as opposed to paying excessive fees for what may in aggregate be just a market or neutral exposure.
Which actually brings me to my next question. How much do you look at fees in determining which manager to work with and perhaps which managers to cut?
It's interesting. Fees are certainly a very important topic for pensions, for all institutional investors. Here in California, we have an annual disclosure that we make in a public session for all private assets. So we do look at fees, but we think it's more complicated than just looking at fees, because if we were to build a portfolio just focused on low fees, it may not optimize our returns. So we look at fees as one of 4 or 5 different dimensions, some of which are quantitative, others of which are qualitative, and it creates things that include returns, performance, things that look at operations. We take into account something that's very important, our ESG considerations, the strategic value of a relationship, diversity and inclusion, and fees are one of those factors that we use in our comprehensive analysis.
John Grable, thank you so much for taking the time. I wish you all the best with respect to the fires and everything else. John Grable, Chief Investment Officer for the Los Angeles County Employees Retirement Association, joining us from LA. Coming up, the album tied to Nirvana's iconic performance on MTV's Unplugged sold millions of albums. But how much did Kurt Cobain's sweater from that event sell for at a recent auction, including those cigarette burns? We tell you next. This is Bloomberg Money Undercover. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Time now for our billionaire beat. Vista Equity Partners Robert Smith is one of the world's richest people with a $6 billion fortune, and he has pioneered an increasingly popular way to free up some of that treasure. Bloomberg's Tom Metcalf now joining us from London. So I want to get your sense, Tom. What exactly is he doing to free up this cash?
Yeah, so he's pioneered this really interesting trend that's spreading through private equity. Basically what they're doing, private equity founders that is taking a minority stake of their firm, be it Vista Equity in Robert Smith's case or Platinum Equity in Tom Gore's, and effectively selling that on to bulk buyers. Some of these names may be familiar: Dial, Blackstone, Goldman Sachs. And basically those buyers are just trying to get a slice of the private equity returns that these firms are seeing, whether it's management fees, carried interest. And this is really causing an explosion in the sort of the value of the fortunes of these private equity tycoons. People like Robert Smith, who's on the screen right now, he's been able to sort of monetize some of this wealth that's locked in his firm and become one of America's most prominent philanthropists. He's bought plenty of property. So it's kind of spreading across the whole industry as people look at people like Smith and go, hey, this seems like a great way of boosting our fortune. Yeah, and on the flip side, there's an increasing interest in investing in private equity firms, even from other private equity firms saying we're going to take a stake in one another in order to juice returns. Who's been sort of the most active on the buying side? Do you have any idea, or do you have any idea of how much more active this market has gotten recently? Yeah, well, so the sort of poster child on the investing side for this is really Dial Capital. So, maybe 10 years ago, they started to shift from investing in hedge funds into private equity. And they've really led the charge in terms of they've done certainly the most deals. And in terms of the overall market, it's really gone from basically nowhere a decade ago, one deal maybe a year. Now you're seeing something like 20 deals a year. And someone like Dial, they've just gone out and raised an $8 billion fund precisely to invest in private equity firms, and they've already pretty much committed or spent most of that money. I do have to wonder how much this sort of shifts who's in charge and who's got sort of the most at stake. I mean, with a lot of people getting out, and I'm just wondering, are there other private equity titans that have been involved in selling some of their stakes? Yeah, so it's pretty much all the big names you'll be familiar with have probably done it. This is a firm called New Mountain Capital, and their founder Stephen Klinsky, they sold a stake off to Blackstone. You've got Silver Lake, the big tech investor. They sold stakes. You've also got HIG in Miami. So pretty much a lot of the big names, albeit not the ones that have obviously gone public, like KKR or Blackstone itself. But otherwise, if you're kind of a successful private equity firm, you're certainly having these conversations, and a lot of them have already sold minority stakes. Tom Metcalf of Bloomberg News, thank you so much for being with us. Sticking with big money, there is a global battle to manage the ballooning money and affairs of the top 1% and 0.1%, with a main focus on, get this, Germany. Bloomberg's Danny Berger joins us now with that story. Danny, I find this interesting because you think of Germany as being in a recession, as having a really difficult time. How significant is the billionaire population in Germany?
Yeah, I mean, Lisa, if you've been paying attention to the German data releases at all, this at first glance is confusing. But when you look at the global rankings of what countries have the most wealthy population, Germany comes in third in terms of most ultra high net worth individuals. And it's really a perfect storm here because you also have an aging population. In that aging population, they're likely to be selling their businesses, which means you have an extra added liquidity in these German accounts that frankly aren't going to go into saving accounts with negative yields. So you have these big banks starting to bet that those clients, they're going to need to go up the risk curve and turn to wealth management in a more profitable and frankly stable income for these firms.
What is wealth management when you talk about that?
Sure. So wealth management, it really is becoming an increasingly important part for these banks, and especially high net worth individuals. I mean, we've seen personal fortunes grow at a really rapid pace, and they need more professional, they need more advanced teams to really look over it. So it's not just a Germany phenomenon. This is really global. You look at UBS, you look at Morgan Stanley's earnings, all of them point to wealth management saying, look at how important this is, look at how much we're earning. Because the thing with banks right now, if you can't make money on spreads, you're going to want to do it in fees. And banks already are struggling with how to pass on, or if they pass on, to what degree they pass on those negative rates onto their clients. So we see wealth management, money management allocations, those decisions are becoming more important for these banking divisions.
Is there or are there any specific challenges when you're talking about German billionaires in particular?
Yeah, well, the market is extremely fragmented, something like 1,500 private banking firms in Germany. And we've seen foreigners try to come in and break this market, and it's been really difficult. So there definitely needs to be more consolidation within the industry in Germany. And then you have a investing base that's really traditionally more risk adverse. So it's going to be more difficult to get these consumers out of savings accounts and into the risk ladder. And we definitely do see private lending, private equity become more popular, but it certainly is an uphill battle.
Danny Berger, thank you so much for that. And speaking of big money, it is time for this week's big number. It is tied to the vintage green cardigan Kurt Cobain wore for Nirvana's iconic performance on MTV's Unplugged. It sold for $334,000. It's the most expensive sweater auction of all time, especially considering that I believe it had cigarette burns. The late musician's clothing is unwashed, yes, and it still has stains from cigarettes, and was purchased for $137,500 just 4 years ago. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 5 p.m. London, 1 a.m. in Hong Kong. This is Bloomberg.